Most people think that by tapping your retirement accounts early, that means a 10% penalty. But what if I told you there are legal, smart ways to access those funds without getting hit by the IRS? Hey, if you're new here, I'm Jonathan Rankin, and for nearly 20 years, I've helped people retire with confidence. So whether you're facing a job loss or want to retire early, or you just simply need cash for a major life event, the idea of touching retirement savings early can feel like walking through a minefield. And in this video, I'll show you the rules, the loopholes, and the strategies to access your money early and penalty-free. Now let's face it, life doesn't always follow a neat timeline. You see, early retirement, medical expenses, starting a business, or just covering bills during a tough year, there are plenty of reasons that people need to tap their money before 59 and a half. But the problem is that the IRS hits you with a 10% early withdrawal penalty. So if you take $50,000 from your IRA at age 50, well then you're going to owe an additional $5,000 on top of the income taxes, unless you know the exceptions. So let's break down the legitimate ways that the IRS allows you to avoid that 10% early withdrawal penalty, even if you're younger than 59 and a half. And these are based on the IRS hardship rules plus newer rules introduced under the Secure Act and Secure 2.0. Now, the first exemption that you might qualify for are medical expenses. You see, if unreimbursed medical costs exceed 7.5% of your adjusted gross income, then you can withdraw IRA funds to cover those costs penalty-free. Now, the next exemption is if you are totally or permanently disabled, you can access your retirement funds without penalty. And then there's the first-time homebuyer, which will allow you to withdraw up to $10,000 from an IRA, not a 401k, to help you buy or build your first home. And then there's qualified education expenses, things like tuition, books, supplies, even room and board for you, your spouse, children, or grandchildren. That would be penalty-free as well. And if you're unemployed and receive unemployment benefits for 12 weeks, well, you can actually use IRA funds to help you pay health insurance premiums without penalty. And then if the account owner passes away, well, the beneficiaries can access funds penalty-free as well. Now, if the IRS levies your account to collect back taxes, those withdrawals are not penalized. Now, the Secure Acts of 2019 and 2022 added even more flexibility to early withdrawals, and those included things like penalty-free withdrawals for birth and adoption, which allows you to withdraw up to $5,000 per parent per child within 1 year of the birth or legal adoption of a child. There's no penalty, and the funds can actually be repaid back into the account later on. And then there's the new emergency expenses that was introduced in 2024 under the Secure 2.0 Act that allows you to take a $1,000 penalty-free emergency withdrawal from your 401k or IRA each year for immediate personal or family needs. Now, you do have to pay this back, and you have 3 years to repay that withdrawal. And if you don't repay it, then you can't take another emergency distribution for 3 years. Now, another exemption that most people are unaware of is the federal disaster relief withdrawal. So up to $22,000 of penalty-free withdrawals if you live in a federal declared disaster area and suffer economic loss. And this applies retroactively and prospectively for new disasters. Now, before we dive into the most powerful strategies to help you avoid penalties for your withdrawals, I want to take a second to introduce you to our free retirement readiness quiz that's linked in the description below. This is a quiz that's going to help give you a personalized result of what your retirement is actually going to look like. It's not just some online calculator that's going to give you a generic result. In fact, a member of our team is going to analyze what you put in, and we're going to send you a personalized video explaining exactly where you stand today and some things that you might want to be aware of as you plan your retirement. So go ahead and check out that link below. It's completely free, and we look forward to hearing from you soon. Now let's dive into some of the most powerful strategies to help you avoid the penalty. Now the first is what they call 72T, or substantially equal periodic payments. This allows you to take penalty-free withdrawals from an IRA before 59 and a half. But the key is that you have to commit to a strict distribution schedule. So you'll take equal payments every single year based on one of 3 IRS-approved calculation methods. Now, this is one of the only strategies that lets you access large sum of your retirement money early without specific hardship triggers. But it does require a long-term commitment. And it's important to understand the rules, so let's break those down. You see, you must continue taking the same amount for 5 years or until you turn 59 and a half, whichever is longer. There's no skipping years and no changing the amount. And it applies to only IRAs, not 401ks, unless you separate from service. Now, if you break the schedule, well, the IRS is going to hit you with retroactive penalties and interest. So let's look at an example. Let's say that you're 50 years old and you want to retire right now, and you have $600,000 in your IRA and you need $30,000 a year to live. Well, you can set up a 72T plan and start taking $30,000 a year until you turn 59 and a half without penalty. But remember, once you start, you're locked in. Now, the next strategy to help you avoid a penalty is you could actually take Roth distributions from Roth IRA contributions, not earnings. You see, you can always withdraw your original Roth IRA contributions, just not investment gains at any age, and that's tax and penalty free. And that's because you already pay taxes on those dollars. And this gives you incredible flexibility if you've been contributing to a Roth for years. It's basically a built-in emergency fund. It's tax advantage and it's accessible. But, and this is critical, earnings on your Roth can only be accessed tax and penalty free if you meet the Roth IRA 5-year rule and one of the qualifying reasons, age 59 and a half, disability, first-time home purchase, or death. Now, the 5-year clock starts on January 1st, the year you make your first Roth IRA contribution, not the date you contributed. So let's look at an example. Let's say that you contributed $60,000 to your Roth over the past decade and it's grown to $90,000. Well, you can pull out $60,000 anytime tax and penalty free. But if you dip into the extra $30,000 in growth before age 59 and a half and before your Roth has been open for 5 years, that's where penalties can apply. Now, the next strategy to tap into your retirement money before 59 and a half without a penalty is you could look at a 401k loan. See, some employer-sponsored 401k plans allow participants to borrow against their balance up to $50,000 or 50% of your invested balance, whichever is less. You're not taxed or penalized as long as you repay the loan on time, which is usually within 5 years. And it's one of few ways to access retirement money without triggering any IRS event at all. Now, it's important to understand the rules of 401k loans because it could come back to bite you if you don't follow them correctly. Now, they're only available if your employer allows it, and they're not available in an IRA. I get that question all the time is, can I take a loan against my IRA? Unfortunately, they're only allowed in 401ks where the employer plan allows it. Now, interest is charged, and it's usually prime rate plus 1 or 2%, but you're technically paying yourself back. Now, you must repay the loan in full if you leave your job or it becomes a taxable distribution. So this is where things get tricky, because if you don't stay at your employer for the term of the loan, then all that can become a taxable distribution, and many people forget about that when they leave their company. See, this is a loan, it is not a withdrawal, and it doesn't affect your contribution limit. So let's look at an example. Say you have $200,000 in your 401k and your 401k plan allows loans. Well, you borrow $25,000 to help with the down payment on a home, and you pay it back over 5 years with monthly payments and interest. There's no tax, no penalty. Just don't leave your job mid-loan unless you have a plan. Now, at the end of the day, how you access retirement funds early comes down to why you need the money and how long you'll need it. If it's a one-time emergency, well, a $1,000 distribution or a 401k loan might be all that you need. But if you're planning a full early retirement, something like a 72T schedule might make more sense. And if you've been building a Roth IRA over the years, then you may be able to already access penalty-free contributions without even realizing it. See, every strategy comes with its trade-offs, whether that's limited flexibility or strict repayment rules or long-term tax consequences. The key is making sure that you're not just avoiding the penalty today, but you're avoiding the regret down the road. And that's exactly why we built that retirement readiness quiz, so you can see how these strategies fit into your personal plan and timeline. It's not automated or generic. Our team will personally review your answers and give you feedback tailored to your situation. So take the quiz below, and if you haven't already, do me a favor, hit that like and subscribe button and share this with someone that you know who's thinking about retiring early or just needs some help planning their own retirement. Now, if you're thinking about retirement, make sure you check out this video coming up next where I talk about 4 life-changing ideas to help you live your best retirement. I'll see you there.